Welcome again to Outlook 2026. Prepare to be shocked, navigating realities in the artificial intelligence economy. I'm Matt Jenskow, investment strategist here at Waddell and Associates, and it's my pleasure to kick off the live session. We appreciate you carving out time of your busy days to be here with us. If it's your first time, welcome. Waddell & Associates is a wealth strategy firm committed to enriching lives by providing clarity. Our speaker today, CEO and Chief Investment Strategist David Waddell, is a leading voice in economics and investment strategy. David is great at cutting through the financial fog, per se, and is featured frequently on CNBC, Fox Business, Forbes, Wall Street Journal, Barron's, you name it. Today, David will walk us through some of the important forces shaping the economic landscape today, current market environment, policy developments, and trends to watch as we progress here in 2026. If you have questions today, you can submit them using the Q&A feature on Zoom, and David and I will get to address as many as we can at the end. And with that, I will get out of the way. Please enjoy Outlook 2026. David, over to you.
Thank you. Good morning, everybody, and thank you for clicking in. Those of you who are longtime listeners know how much work it takes to get to this moment every year. And because of that, I want to put forth a couple of shout outs before I begin. First, thank you, Matt, for that introduction. Thank you also for all of your support on the investment committee and ensuring that our portfolios align with the outlook that we're going to present here today. Nola and Nicole have done a fantastic job converting what was in my head, mostly charts and numbers, into this outstanding presentation you see before you. So thanks, guys. Truly talented and appreciate your efforts. And then also, Lainey, thank you so much for providing such great security on my calendar so that I could have the headspace and the time to do some deep thinking. And also create this presentation. I really appreciate that. And lastly, to all the W&A associates, you work tirelessly on behalf of your clients and also on behalf of each other in this time of year on behalf of me as well. So thank you. It's really a truly A+ team, and I'm really grateful to be a part of it. So I titled this year's presentation, Prepare to be Shocked, Navigating Realities in the Artificial Intelligence Economy, to acknowledge that the pace of technological change and creative destruction right now is really only accelerating. And the impact of those changes are going to be profound. And frankly, they're barnstorming every aspect of our realities. This is just the most significant and profound technological adoption cycle we've ever been through as a society. AI will have profound impacts on our political realities. AI will have profound impacts on our economic realities, on our labor market realities, on all sorts of facets of our personal lives, and certainly within the capital markets, which is ultimately what we're here to discuss today. But this rapid amount of change and creative destruction also seems at once both fascinating and also terrifying. So the right question to ask is this good news? Is AI friend or foe? Are we entering the best of times, or is it possible that we're entering the worst of times? It was that profound question that I endeavored to answer when I took on this assignment, and that's what I will ultimately share here with you today over the next hour or so. I haven't said this all out loud yet, so we're both hearing it for the first time. But before we go forward, let us speed read some disclosures and then also take a look back. This time last year, I stood before you and presented Outlook 2025. That's the spirit, how the revival of animal spirits will impact economies and markets in the year to come. As an acknowledgement of the fact that really expectations were very high coming into the year, moods were very, joyous, and while we celebrated that, we also warned that there might be some risks inherent in the enthusiasm. But it was right for people to be excited coming into 2025. The economy was absolutely roaring. And if you look at post-COVID GDP growth overall through the end of 2024, it really has been an astounding run. So long run potential GDP growth, according to the US Federal Reserve, should be about 1.9%. Here's what we've been doing post-COVID. Over 17 quarters into the end of 2024, only 3 of them produced GDP less than the long run potential growth rate, and only 1 quarter was negative, and that's just because inflation was so darn high. Overall, for that 17 quarter stretch, we've been growing at 3.3%, nearly twice as much as the potential growth rate of the US economy going into the end of 2024. And how have we powered this economy at such a high rate of growth? Well, your US government has never been more generous. So on this slide, what I'm showing you is the fiscal deficit going back from 2020 to 2015. Over that 5-year period, the government stimulated the economy by spending more than they tax by about $3.4 trillion. Since then, the government has passed to you, the consumer, and also to corporations about $11 trillion through deficit spending, adding enormous levels of stimulus to the economy overall. And because of that, going into the end of 2024, consumers had never been better paid. So if you look at disposable personal income, prior to COVID, people were making about $16.5 trillion total. At the end of 2024, they were making $22 trillion total, which is up 33%. Fairly nice raise. And then if you look at household net worth, US consumers ended 2024 having never been richer. Pre-COVID, we had household net worth of $120 trillion. By the end of 2024, that number had gone to $170 trillion, up 42%. That's a whole lot more wealth. That's a whole lot more spending power. And because of that, US stocks had been on an absolutely terrific run between the year 2020 and the end of year 2024. Consider, even in the year where we had a global pandemic, the S&P 500 in 2020 was up 18%, hit 33 new highs. In 2021, the S&P was up 29%, hit 70 new highs. In 2022, chickens came home to roost a little bit with all that stimulus. We had runaway inflation, made the markets a little nervous. We went down 18%, but we still managed to squeak out 1 new high. And then in 2023, we had a dramatic recovery with the S&P up 26%. And although it didn't hit new high, the Dow Jones Industrial did, keeping our string alive. And then ultimately in 2024, markets rose another 25%, hit 57 new highs. And for the entire time period, the S&P has appreciated going into the end of 2024, 100%. No wonder people were feeling so good. Well, going into 25, because of all that, retail stock investors really expected price appreciation to be, again, at record levels going into the year. So retail return expectations really had never been so high for investors. But it wasn't just retail investors. If you looked at the Wall Street strategists, they were extra bullish as well going into 2025. The median target for all of these listed on your screen was 6,600, which equated to about a 12% gain in the S&P 500. That may not sound impressive, but on average, strategists typically expect the market to rise 9% on an annual basis, making 12% for them a pretty darn bullish call. But any call about the prosperity in the markets for the year to come in 2025 had to begin with a call on what Trump's policy agenda was going to be for 2025, with the default assumption that Donald Trump himself seems to like wealth a good bit. And therefore, maybe for all of us, he'd like to see all of us a little bit wealthier. And so the basic assumption is that Trump's prosperity agenda would be good for markets overall. Well, of course, one of the things he promised to do entering office was to raise tariffs. The idea being that higher tariffs would create more revenue, foreigners would pay it, our deficit would go down, and this would create more net worth for the country and improve the books of your federal government. Well, if you go back to tariffs all the way back to 1900, you can see we've been on a long progress lower as the way to promote prosperity. And so higher tariffs seemed like an unusual way for us to achieve more prosperity. But then again, Donald Trump's somewhat of an unusual guy. We expected going into the year that Trump's policies would ultimately settle down to where tariff rates would go from 2.5%, where they began 2025, to 12% perhaps by the end of the year. A pretty high level, but not enough really to destabilize the economy, not enough to throw us in recession, but enough maybe to irritate the markets. So if we go back to Trump's first administration and we consider his first tariff war with Xi Jinping, that started in January of 2018. This is a chart of the S&P 500 over the time period. It ended in about September of 2019. And over the course of that extended period, the S&P really didn't go anywhere. It was volatile. We had a near bear market. And so it gave us some concern that while he was negotiating his trade tariff impositions, that the market would be capped somewhat on the upside until the coast was clear. And then we got what was a pretty dramatic surprise in the Rose Garden when Trump unveiled this crazy menu of reciprocal tariffs well above what anyone thought would be his tariff effective rate. So much liberation here on Liberation Day. So on that day, he really channeled his presidential spirit animal, President McKinley, who levied 29% tariffs in 1900. Trump paid homage to him with 28% tariffs. And that created, as you know, just mass chaos and confusion in the marketplace. This is actually a measure of policy chaos and confusion known as the Policy Uncertainty Index. And you can see the reaction to Liberation Day was higher than the uncertainty generated by the great financial crisis, higher than the uncertainty generated by COVID, because we didn't know what he was trying to do. Is he really trying to reindustrialize America? Is that even possible? Is he really trying to reduce the deficit? Will this work? Will it crash the economy? You know, is he really trying to renegotiate trade deals? So is the 28% tariff just an opening statement with the ambition that tariffs will go lower? Mass chaos and confusion, which of course immediately put the prognosticators on alert. And we saw some headlines like Trump's tariffs will be bad for you, and you, and you, and you. That was CNN. Trump's tariffs raise odds of U.S. recession. Wall Street economists say. That was CBS. And then Yahoo Finance, perhaps this is my favorite, JP Morgan becomes the first Wall Street bank to forecast a U.S. recession following Trump's tariffs. Immediate maximum headline pessimism, which created within the markets a whole lot of volatility. So this is the S&P Volatility Index, also known as the Fear Index. And you can see Liberation Day took us to levels we hadn't seen since a global pandemic and a global financial crisis. That's how big a deal this event in the Rose Garden for our benefit was within the stock market. The stock market fell about 21% intraday from top to bottom within under 30 trading days. That is a cascading decline and got us pretty close to a bear market. It didn't end up closing down below 20%, so technically it didn't become a bear market, but it certainly knocked its bull on its keister. But when we looked at that, we took a step back and said, okay, I mean, there's been a lot of uncertainty. There have been a lot of headline pessimism. We've seen a waterfall decline in the markets. You know, it's possible that Trump could just change his mind. And so we went back and looked at the data and found that in every average year for the VIX, the market's up about 12%, 25% 2 years later, and you can see the numbers as time extends. But in years when the VIX actually closes above 47, from that moment going forward, that period of maximum pessimism maximizes opportunity. 1 year later up 36%, 2 years later up 56, 4 years later up 91, 5 years later up 133. So to us, it perhaps gave us an opportunity to harvest some tax losses, reposition the portfolio, and take advantage of what could be a recovery if Trump changed his mind. Also, after these steep cascading waterfall declines. You tend to get the biggest bull market up days in history, in fact. So if you go back and you look at the post-war period, the biggest gains always follow the biggest losses. So 2008, 2020, 87, 2009, 48. You can see on those days, something changed. Markets rallied anywhere from 7% to 12%. And we expected that could happen as well. And right on cue, on the 9th of April, Trump changed his mind while I was in a taxi on the way to CNBC headquarters to do power lunch. And maybe the most fun I've ever had was sitting on that set while the stock market went up 10%, which was the third largest one-day gain in the post-war period. But it wasn't just the one-day event. That kicked off a series of advances that ultimately took us back to a new all-time high by June. So some analysts look back and say, you know, that was the Trump always chickens out moment. But really there was more to it than that. And this is what's really fascinating, is what it kicked off at that moment was actually a series of tariff cuts. So Trump took us from 2.5 to 28, and then he began a series of negotiations that ultimately cut tariffs down to a year-end applied rate of about 16%. But here's the interesting part. So if you actually do the math, and you take the amount of tariff revenue coming in, which is about $30 billion a month, and you divide it against the total amount of imports, what you'll find is the effective rate is actually 12%, exactly where we thought it would end up by year end. We just didn't see the absolute mayhem that would be caused in the process. But that wasn't the only campaign promise Trump made to promote U.S. prosperity. He also told us that he would lower our taxes, and he did. On July 4th, he signed the One Big Beautiful Bill. In addition to the $3.5 trillion tax cuts from the Tax Cut and Jobs Act he signed in 2017, we got another $1 trillion in new taxes. He said he'd lower our taxes, and he did. He said he'd lower our interest rates. People were somewhat dubious of that. This is the Treasury yield curve at the end of 2024. By the end of 2025, indeed, interest rates had fallen. Interest rate on the 3-year went from 4.37 to 3.67. Interest rate on the most important measure, probably the 10-year Treasury bond, went from 4.58 to 4.18, where it resides today. And so overall, interest rates across the complex, other than the 30-year, which people don't really use much anymore, but did come down. He told us that he would lower oil prices. Well, hard to do. Takes a while for drilling to heat up, but overall U.S. oil production did go up about 3%. Price per barrel went from $72.44 to $57.26. So he said oil prices would go down. They did. He said he'd lower inflation. That seemed somewhat, difficult. But we went from 2.87. Reason I've got a dotted line here is they also shut down the government and there wasn't any data released at that time. Picks up again. Ultimately, we got to 2.65%. So indeed, inflation did fall throughout the course of the year. And then he also told us that he would grow this economy like we've never seen before, right? So here is real GDP growth at the end of 2024. First quarter of 2025, people stockpiled imports because that's a negative impact on GDP. We actually had a negative print for first quarter GDP. Second quarter, third quarter, off to the races. Fourth quarter, before we got a data point yesterday, didn't change it much, maybe running around 4%. So Trump ended up growing the economy at a 3% annual rate despite a negative first quarter for the totality of 2025. By the way, there was a report yesterday, I think, that came out that also showed that so far in this fiscal year, he has cut the deficit by 20%. I mean, I don't know that I would have thought all this was possible, but it is at the moment. It's not just Trump. There's other stuff going on. We'll talk about that. So Trump also is famous for saying that money was never really a big motivation for me, except as a way to keep score. Let's check the scoreboard. So when you go back and look at 2025 from a performance standpoint, stock markets did well, emerging markets did best, developed markets did best. Some of that stimulated by a decline in the US dollar. But overall, as a group, stocks did about 17%. That's pretty darn good. In terms of bonds, because we didn't have any recession risk, spreads stayed low. Because rates came down, prices went up. That was good for bonds. The complex overall up around 8%. And if you look at commodities, the panic attack that Trump created in April created a little bit of a run on the dollar, maybe, but it certainly created a gold rush. Gold was up 64% last year. Copper, calibrated with the strength of the U.S. economy, they call it Dr. Copper. My desk is copper at home. Was up 41% last year. Industrial metals up 20%. That's just a great year. So overall, commodities we're up 16%. How did you lose money? Well, you lost money on oil because Trump told you he was going to take those prices down, and whether he can take responsibility, they did go down. And you lost money on your Bitcoin, which went down 6%. Obviously, it struggled some more this year. The US dollar went down around 9%, technically still overvalued. And so that'll be an asset class to watch. But overall, a very successful year and should make Americans very happy. Overall, if you look at net worth, it went up probably about 15% last year. So an extremely prosperous year, which should benefit, Trump in the voting booths. But in the age of AI, take nothing for granted. So now let's talk a little bit about how this filters in to our outlook for 2026. And we'll start with political realities. So AI does impact political realities in many ways, but let's talk a little bit about the payoff Trump is getting for all this prosperity. Well, he doesn't seem to be able to buy any love. If you look at consumers, even though their wages are at an all-time high, even though their net worth is at an all-time high, stock market's at an all-time high, they are the most pessimistic they've been at any time outside of a recession. So the consumer sentiment index is really plumbing all-time lows at 52.9. What about investors? Well, they should be pretty darn happy after a couple of years of, basically 20% gains, almost 3. But yet there were actually 10% more bears than bulls for the totality of 2025. And that's a level that we've only seen previously in recessions. And if you look at overall voter opinions, the presidential approval rating after 1 year for Donald Trump in his second term is 36%. That's the lowest of any presidential candidate after their first year, going back to Jimmy Carter. So what's happening here? Trump's delivered on all this stuff, record levels of prosperity, and yet everybody's miserable. So what is the problem? The problem is this: people in America hate inflation more than they love anything else. If you look at this study, so let's take the cumulative inflation rate, steady state, basically at the Fed's target, and go back to 2015. It was on more or less a 2% annualized trajectory. And then assuming that it was able to maintain that, we would have gone from a 230 index to a 290 index. That's what we're used to. What we are not used to is 4% annualized inflation. And that really kicked off in January of 2020 as all that government money from Congress and also from the Fed spilled into our mailboxes, driving up prices for goods, driving up prices for services, you know the drill. So really, inflation is 12% above the 2% trend we've all gotten used to. And if you just take it in absolute sense, inflation is 25% above pre-COVID levels. Just ask people to go to dinner with me. Doesn't matter where I eat, doesn't matter how much I enjoy the steak. I am always complaining about the price of the meal. And this is just very, very, very difficult to deal with. This has become known as the affordability problem in the United States of America. This is why everybody's so miserable. So, of course, Trump comes up with a grab bag of solutions. He'll shoot at anything here to try and curry favor with the voting base, to make America affordable again. We've already passed no taxes on tips, overtime, Social Security. There's been some discussion about mailbox money for all of you, $2,000 rebate checks that are your tariff rebates. There's been talk about capping credit card interest rates at 10%. We've obviously got issues in a mismatch of supply and demand in the housing market. And so Trump said maybe no institutional buying for that. Asking Freddie and Fannie to buy up $250 billion worth of loans, tying government allocations to states, trying to loosen permitting process for new home construction. He's also suspended student loan garnishments, or suggested that, eliminating junk fees on like your Ticketmaster fees. I mean, that's hit the wall as well. And then the newest one that hit the wall was maybe raise the minimum wage. So Trump is doing everything he can to try and address the affordability issue. Unfortunately, I don't think that's possible, right? Because unless you have disinflation, even if you bring inflation back down to the Fed's target rate or even below, prices are still going higher. So Trump remains, because of this, in the midterm danger zone. His approval rating is 36%. If you go back and look at other midterm moments for presidents, anytime a president has an approval rating below 40%, on average, they lose 38 House seats. Don't take my word for it. We have betting markets for everything now, and you can bet on which party will win the U.S. House. I think I used Kalshi for this. And you can see the betting markets think that Republicans have a 22% chance of keeping the House. Democrats have a 78% chance of taking it. So if you're Trump, what do you do? Well, if 3% growth can't seem to buy any votes, which is pretty darn good. I mean, if you look at it, we haven't had a real 3% growth rate outside of the COVID recovery in a long period of time. But Trump says, if 3 doesn't work, how about 4%? So he has said, I believe it's time to establish a national goal of reaching 4% economic growth. If we do that, that'd be the highest level of economic growth in decades on an annualized basis, other than the COVID spike. So will that work? I don't really know. Is it possible? I don't really know. But if you're going to achieve it, you got to do some more stimulus. And so in pursuit of that, the one big beautiful bill adds a whole lot more stimulus to the economy. We get tax cuts, some SALT relief, we get some new spending, and then there's some Medicaid cuts and some other, Inflation Reduction Act rollbacks, which obviously wasn't an Inflation Reduction Act, and some other tax offsets. But when you put it all together, $270 billion of new government spending will enter the economy this year, which equates to about 1% of GDP. That's a whole lot of fiscal stimulus. If you look at 2027, if you look at 2028, the numbers are much lower. Neither of those are midterm election years. He also needs huge monetary stimulus from the Fed. If you look at what the markets are predicting right now, we ended last year at 3.63% in the effective federal funds rate. It expects that we'll be at 3.03% by the end of the year. So maybe about 2 rate cuts. Additionally, there has been recently some balance sheet expansion, also known as quantitative easing. The Fed, after trimming its balance sheet for a while, has allowed it to accordion a little bit higher, up about $70 billion. As you know, Trump has just nominated Kevin Warsh. The market's not quite sure whether he's a hawk or a dove, but my guess is, in a way to honor Trump for the decision he made to appoint him Fed chair, he will likely cut rates. And if he's going to do anything on the balance sheet side to begin quantitative tightening in or shrink the size of the balance sheet, my guess is he waits until after the midterms. So I do think we'll end up getting plenty of monetary stimulus. And then what about the regulatory structure? You don't see this. It's more of an anecdotal study. One way to look at it is the total number of capital markets, or the total percentage of market liquidity as a percentage of GDP. How's the IPO market? How's the high yield bond market? How much issuance are we getting in levered loans used for merger and acquisition activity? And you can see we were at very high levels in 2021. Whole lot of regulations hit the marketplace, collapsed down, and we're still at a below average rate of 3% of GDP. This I know, Donald Trump loves deal making. He believes it unlocks prosperity. I would imagine, although it may not grab headlines, that you'll see a whole lot more marketplace liquidity and that this number will go up over the course of the year. Now, Trump can add a whole lot of fiscal stimulus. Trump can add a whole lot of monetary stimulus. Trump can add some deregulatory stimulus, but the labor market is kind of going its own way right now. So let's dig into some of the labor market realities as we enter the year. Last year, based upon the revisions yesterday, the labor market on average added only about 15,000 jobs per month. If you look at the last 6 months, it added only 3,000 jobs on average per month. This is a total stall out. So it's been a no hire labor market, and some have said this is a recessionary signal. However, it's also been a no fire labor market when we look at unemployment claims. Unemployment claims have basically flatlined, and in fact, they've come down as of late. So while there isn't any real surge in hiring going on, there's also not a surge in firing, which means that the unemployment rate remains pretty low at 4.3%. Yes, it's ticked up some, but still well below the 5.7% long-term average. So our overall employment market is still strong, but definitely something going on there. And what's going on is there are just fewer foreigners getting involved. So this first chart charts working age, unauthorized, illegal immigrant employees. And as you can see, not only has the amount of illegal labor declined, it's actually gone negative, meaning not only are we not bringing illegal workers in, we're actually throwing illegal workers out, or they're leaving under threat of ICE or whatever the issues are. Nonetheless, the labor force that was illegal immigrants is reversing. Furthermore, the labor force of legal immigrants, those who are foreign born but participating in a labor force, is also declining, probably under threat of ICE or whatever the headlines have them thinking. Actually, Trump's deported less people than the previous 3 presidents by this point, but the media does what the media does. Anyway, so we are seeing fewer foreigners, which means we've got fewer foreign workers. Well, what concerns me there is, what if we actually see labor demand increase, right? If the foreign laborers are heading home and we have to rely on our indigenous labor supply, which I'll talk more about, that could create some shortages. Shortages could create some inflation. Inflation could create some real irritants for this administration. And we've seen a little bit of a wiggle higher in job openings. We've seen a little bit of a wiggle higher in hires. Yesterday's non-farm payroll number showed 133 new jobs, or 130 new jobs were added in January. That was twice what analysts expected. And so it could be that this economy reaccelerates and labor demand reaccelerates alongside of it. But let's take a longer term view of what's really happening with US labor supply. So this is the birth minus deaths model, right? And this is our baby factory, which is a little bit of our labor supply. Last year, there were 3.5 million Americans born, maybe 3.6, and 3.1 Americans died. And so if you extrapolate that out a few years, actually by 2030, the number of births and the number of deaths ends up being kind of roughly equivalent. So if we were just in a closed system, that would mean that our labor supply should start shrinking not too far in the distant future. If you add immigration into the mix, which the US has also always had a healthy immigration flow, things end up looking a whole lot better. You can see the amount of net immigration when Biden opened the border and flooded the US with legals and illegal immigrants, which again got absorbed some in the workforce. And then you can see where Trump closes the border, which constricts labor supply. Once you get past 2026, the Congressional Budget Office doesn't know what the immigration policy persuasions are going to be. And so it just sets a steady state growth rate. That's unlikely, but you can see, but for immigration, the US labor force likely will not grow. And so because of that, it's important to understand that necessity is the mother of all invention. And we're on the edge of having pretty significant labor force scarcity and supply issues. And so the mother of all invention is definitely AI. I mean, we've never seen anything like this before. Its deployment has been completely unprecedented, and I'll share some perspectives with you on that. If you look at the internet adoption rate, it took 10 years for 500 million people to use the internet. It took 2 years for 500 million people to use ChatGPT. This is absolutely an unprecedented rate of adoption for any new technology. And this massive demand also creates a need for massive supply. The way to supply a whole lot of AI is to build a whole lot of data centers. And so it's creating an unprecedented amount of AI capital expenditure rates, and it's scaling rapidly. So at the end of 2003 per se, and these numbers get higher every day, we spent $167 billion in the US on data centers. Last year, we spent really over 500 billion on data centers. This year, we'll spend over 600 billion on data centers, up, somewhat 35% over where we were this time last year. It's just unprecedented. And just to put the size of that into perspective, in the first year of 2025, the amount spent on data center construction to satiate the demand for AI was equivalent to the entire amount of US consumer spending. So AI construction basically accounted for 50% of US GDP in the first half of 2025. And we're just getting started. These AI capital expenditure rates are scheduled to go on as far as the eye can see. In fact, globally, spending is projected to reach 3.5 trillion by 2030, up from 350 billion in 2023. And if you look at the pathway just over the next 5 years from 2025, it's projected to be 5x higher than it is today. That's massive, and it's a huge tailwind for the economy. The interesting thing, though, is that current AI usage is solving some problems, but it's not solving the problem. When you ask companies where they're really finding the most labor shortages, it's not really the service-based companies. I mean, at Waddell and Associates, AI is helpful and we use it in some ways, but is it really, are we in an environment where there's a labor shortage? Not really. We've got a couple new hires I'm excited to we'll be announcing soon. We were able to find those bodies. Consumer services, data centers, that kind of stuff. Like, are they really having trouble hiring? No, not really. And so when the services base of the economy, the virtual space, if you will, there's really not a labor shortage issue. I mean, there is, but it's not massive. Where we find the most labor shortage issues are in consumer goods manufacturers, in the military and national security type firms, and then massive shortages in the industrial complex. And so it's not virtual AI that we need so desperately, it's actually physical AI that we need so desperately. So let's talk about the physical AI realities of the day. Now, to understand this part of the presentation, which is very important, to understand this part of the presentation, you have to understand what's called Moravec's paradox, coined by a computer scientist who works at Carnegie Mellon, or used to, in the late 1980s in a book called Mind Children, which I haven't read, but I'm very excited to read. I'm taking it with me on vacation tomorrow. But let's talk a little bit about what this paradox espouses. It says, what's hard for humans is easy for AI. So what I'm doing right now, believe me, was very hard to put together. For AI, maybe not so hard. That's due to the fact that from an evolutionary cycle, the deep thinking part of us has really only developed over the past 1,000 years, whereas the motor skills part of us has been developed for millions of years. And so what's easy for humans is hard for AI. The hardest thing for physical AI is this. Hands are very, very difficult. And so physical AI, very hard. Virtual AI, not as hard. We've already made tremendous progress there. But we're also making progress on the physical side as well. You probably didn't consider it this way, but that Roomba that may be scurrying around your house right now is actually an autonomous vacuum. It exists in a closed space, it has little parameters, but it does have sort of an autonomous nature, and it was an early look at what robots can do. Came out in 2002. So far, iRobot, I guess, sold about 50 million of these units. That was an early look at a low-level physical AI device. Now, coming into this year, I don't know if you've seen it, but in Nashville per se, and certainly in San Francisco, you see Waymo cars driving around. Obviously your Tesla has a self-driving mode. Elon Musk has obviously been pushing to get Tesla robo-taxis on the road. And if you look at the amount of miles that will be driven by our robot cars going forward, the numbers are extremely substantial. So we'll go from, call it 116, million miles per driven in 2025 to maybe 16 billion miles driven in 2032. It's just a significant spike in usage for autonomous vehicles. And now we're on the edge of seeing the first autonomous humanoids in the marketplace. I'll introduce you to Atlas, the work of Boston Dynamics. Hyundai bought Boston Dynamics. They are slated to deploy 30,000, I think, of these robots across their manufacturing facilities. The first one in Savannah, Georgia. Right now, they cost about $120,000. There are none available in the marketplace because they've ingested them all. This is not the only humanoid robot about to be for sale. Obviously, Optimus coming from Tesla. And then there's some other ones, Persona AI and many more that are coming to market. For those of you who are tech nerds, the Consumer Electronics Show was all about robots this year. And if you look at the robot market size between 2023 and 2035, we should see about a 10x spike in the value of that marketplace. Given the massive gearing up in virtual AI and physical AI, it would make sense that there are a whole bunch of people starting companies to chase the dream. That is the case. If we look at US business formations, they are 38% above trend right now. This is where creative destruction comes from. All of these companies that report acknowledge that they will end up hiring people as well. So these are new companies. They'll have new employee rosters. And investor capital is absolutely pouring in. So if we look at AI deals, they're dominating the venture market, and robotics VC deals are reaching an all-time high. As I was putting this together tomorrow, there was a $520 million round that went into a humanoid startup called Apptronic, which is backed from Google and Mercedes-Benz. We're seeing deals like this every day. And then, of course, we have the patron saint of our AI cycle and this adoption cycle right now. And of course, that's Elon Musk. And for those of you with 3 hours to waste, I encourage you to watch his podcast from past weekend, where he talked about taking his robots, loading them up with humanoids, loading them up with parts, sending them to the moon, creating a whole bunch of solar stations that can get a whole bunch of power from the sun directly without any clouds, and then building out a whole bunch of data centers so that we have enough AI capacity, and also some launch pads so that his rockets can take people to Mars to preserve the species. Now, that's a lot. Whether any of that can happen, I have no idea, but I do know that that is driving sort of the pace and thought process and innovation cycle within the economy, and that's very good for economies overall. Okay, here's the net. Let's prepare to be shocked. This is a productivity shock that we're entering right now. So if you look at trailing 12-quarter percentage change and annualized rate, productivity in the United States of America, which is output per employee, is running about 2.6% against a long-term average of about 2%. Usually we only see these kind of spikes in recessions when people companies shed employees faster than output. Last time we saw a period like this was 95 to 2005. And you know that story. Let's take a closer look. So the productivity shock that was the internet had some heroes: Netscape, Microsoft, Windows, eBay, American Online, BlackBerry, you know the drill. On average for that 10-year period, productivity on an annual basis was up about 2.8%, which pushed GDP growth all the way up to 3.4%. Now, modern marketplace economics says, well, if you're going to run GDP at 3.4%, you have to run inflation over target. Didn't happen. Inflation during that period averaged on an annual basis only about 1.8%. That's the beauty of a productivity shock. Now let's take a look at the 2020s productivity shock we're living in today. Some of the poster children: Zoom, NVIDIA, OpenAI, Anthropic, SpaceX. Well, productivity is starting to rise, as I showed you. On an annual basis for the 5-year period, it's up 2.2%. GDP is rising a little bit higher than that at 2.5%. Remember, we've got some labor market growth issues. And we're also seeing core inflation go down. So in my judgment, we're at the early stages of the productivity shock that will come from the adoption of virtual AI, certainly physical AI, and things get much more robust from here and can extend the economic cycle much longer. Now, some people I talk to say, David, this is terrifying. This is competition. We're going to lose our jobs. I will remind you not to be Malthusian. Malthus was an economist back in the 18th century, or I guess late 1800s, who espoused that the population on the planet was going to stagnate. What he missed was that technology innovations would create more food and also a lot more prosperity for everybody. So Malthus was wrong, and I had an economics professor who would remind me anytime I got pessimistic not to be Malthusian. Just to put a point on this, if I look at the Mag 7 companies, I will remind you the average age of the Mag 7 companies is 34 years old. The workforce in the Mag 7 is 2.5 million. If I look at what I'll just call the new magnificence, which is the top 10 companies that have unicorn valuations, they are not public, their age is only 12 years old. SpaceX is actually the oldest name on the list. They've already got a workforce of 250,000 people. So new companies that you've never heard of will come to the table, they will hire at scale, and all of those little startups that we talked about earlier are all hiring people, they're all competing. I have no idea who the winners will be, but my guess is there's going to be plenty of jobs out there for people who want them. Furthermore, perhaps this is most important, I thought about ways to emphasize this more, but if you look at productivity cycles over time, and you map that to compensation cycles over time, there is a very high positive correlation between more productivity and more compensation. So don't be pessimistic, don't be Malthusian. Just because you can't see how you're going to win doesn't mean you're not going to win. Speaking of winning, let's talk a little bit about the market realities of all this as a backdrop. Well, Trump may get his 4%. All of that stimulus adds up. So let's start with our GDP growth rate of 1.9%. We'll add, call it 0.9% for fiscal stimulus. We'll add, maybe another 0.5% for monetary stimulus. We'll add maybe a basis point or so for deregulation stimulus. We'll add 1% for AI CapEx stimulus. And then we'll take something off the table for tariffs or, concerns and disruption that politically get caused by more tariffs and, Supreme Court rulings, whatever the case may be, tariff chaos, we'll just take something off the table for that. But overall, you could see a 4% growth rate. Now, is that probable or is that possible? I don't really know. What I do know is nowhere on here does it say recession. And if there's no recession, historically, really, there's no bear market. So if we go back and we look at the distribution of one-year S&P returns in non-recessionary years, on average, they're higher 85% of the time, and in nearly 70% of the years, the S&P is higher by over 10%. So no recession, no bear market. Furthermore, there are more ways to win, I think, going into 2026. This is earnings and earnings expectations for the Mag 7 companies and also the non-Mag 7s. So if you look at the trailing 3 years, the Mag 7 companies had unbelievably good earnings. They're coming down now as an order of magnitude, while the non-Mag 7 493, those earnings are coming up. The small cap, mid cap earnings are coming up. Expectations for 2026 are that earnings are going to be robust and pretty broad. That will include international, small caps, mid caps. That will include the emerging markets. There are plenty of places to find earnings now within this market. And above average earnings typically mean above average gains. So if you go back and look at years when we had below average earnings growth of 9%, below 9%, markets on average were up 6.7%. Above 9%, they're up about 13%. So no recession, that's good. Earnings above 6 or above 9% estimated, that's also good as an indicator of positive returns. Unless, and I get this question a lot, we are in a bubble. This was the most recent cover of Bloomberg Business Week that said, beware, we're in a bubble. And behind that is this chart that's been circling around that we reformatted of all the circular financing that's going on in the AI space to accomplish that huge AI infrastructure build out. So let's see if we're in a bubble. For that, we have to have a proper analog. So I'll take you back to 12/19/1994, which was the release of Netscape. Over the next 5 years, the NASDAQ Composite Index went up 573%. And if you add in dividends, it was really more than 600%. Now let's trace the pathway of ChatGPT in its release date and start them at the same period. So ChatGPT was released 11/31 of 2022, and so it's been on the marketplace for about 3 years now. What's amazing is that the NASDAQ, through 767 trading days for each of these periods, has gone up about the same. So NASDAQ Web's up 115, NASDAQ AI's up 111. Obviously, if you're comparing against what happened in 1999, we're not quite there yet. The other thing I'll reference is that the internet valuation bubble is very different than the AI earnings bubble, right? So if you go back to the internet time period, and I'm doing 95 to 99 here, when things really caught fire, the average earnings growth for the S&P was 10%. The average PE growth was 15%, which combined for a robust 26%. But by the end of it, look at these valuations. I mean, Cisco was trading at 128 times. Oracle was trading at 120 times. Microsoft was trading at 60 times. Let's compare that to where we are today in this AI period. Average earnings growth between 23 and 27 is projected to be about 12%. PE growth maybe about 6%. So higher E, lower PE. Average returns about 20. The magnificent valuations, and this is current, people still complain that they're lofty. Tesla's nuts at 208 times, but if you believe in Musk, you believe in Tesla. NVIDIA up 25x, or not up, but valued at 25x. Microsoft 28x, half of what it was in 2000. So based upon this, no bubble. The other thing to recognize is that companies are just much better today than they were then. So in the 1990s, the top 10 stocks in the S&P 500 had about 10% profit margins. Today, they have 30% profit margins. But it's not just tech stocks that have benefited. If we look at profit margins across all sectors of the economy, comparing 91 to 2021 average versus 2022 and 2025, you can see margin expansion across almost every sector of the US economy. It's really kind of amazing. So much higher quality earnings, much better company valuations. And the other way to say, is it justifiable? I think a lot about this as a tell from the dot-com peak. At that time, the treasury yield was 6.5%. You get 6.5% on a treasury. The S&P 500 earnings yield, which is the inverse of its PE ratio, was 4%. Obviously, bonds were a much better deal than stocks. Where are we today? 10-year treasury yield, 4.2%, 4.18 when I last checked. The S&P 500 earnings yield, 4.5%, advantage stocks. So when you compare stocks to bonds, stocks are still not overvalued. The only thing that threatens that is inflation. If inflation is contained, it'll contain interest rates, which will provide valuation support. So I'm going to peel back a little bit categorically the CPI right now to tell us where we think inflation will go over the course of the year. So this is shelter inflation. It lags. As you can see, though, it's been on a nice trajectory downward. And then if we look at core services, ex shelter, it's been a little bit more stubborn. It's kind of hard to see maybe in this chart in terms of order of magnitude. It's running about 3% higher than we'd like, but down significantly from the COVID peaks. Then we look at goods inflation. Goods inflation over time tends to actually deflate. Obviously, when we were all buying Pelotons online during the COVID crisis, goods inflation went high, and then things normalized, supply chains opened up, goods inflation resumed its downward trajectory. Then we put tariffs on, goods inflation started going on up again. Now, as we enter 2026, things are kind of returning to normal because those were only one-time price increases. And so core CPI has been falling over the course of the period, and we imagine that it'll continue to float lower towards that 2% target by the end of the year, and that supports valuations. And if you are worried about valuations, and I think about them, if you look at the Mag 7, they trade at 27 times. If you look at the large cap stock S&P 500 index, it trades at 22 times. But if you come down the cap spectrum, and I've been saying this for a while, but it remains, the S&P 400, which is mid caps, at 17 times, small caps you can get for 16 times. Those are reasonable valuations and not beyond their long-term averages by much. And also remember that the US stock market index is not the only world index, right? So the US currently as a complex trades about 22 times. Overseas trades about 15 times. So there's still plenty of real estate for valuations to sort of calibrate and catch up and synchronize once more. So here's how we're positioned for 2026 given all this. First of all, the S&P 500, just picking the benchmark, is 100% US stocks. Right now, we're 71% US stocks, which is a little higher maybe than our long-term average. Things are going well in the US from an economic growth perspective, but we did trim our US allocation last week a little bit more. In terms of market cap, the average stock in the S&P 500 is 125 billion in market cap. We're much smaller than that to take advantage of some of those lower valuations at 55 billion. This is important. Active bet. Magnificent 7 allocation within the S&P 500 is 35%. Our allocation is 8%. Why so low? The amount of competition, the amount of financing appetite, the amount of disruption, and trying to figure out who the winner is going to be and who the loser is going to be makes that a very difficult box. And we've been rotating away from it for a while. As you know, markets kind of gotten religion on it. Magnificent 7's actually negative on the year. I think it's going to take a while to sort out who the winners and losers are in this whole AI adventure. So where did that money go? It reallocated to what I call the Trumponomics allocation, which is financials, industrials, energy, and materials. If you look at those sectors, we're 43% allocated versus an S&P 500 of 25% allocated. And then lastly, if you look at PEs overall, and I care about them, the market's at a 22 PE. We're less than that, down at an 18 PE, which is more normalized relative to history. So that's how we're positioned and feel good about it so far into the year. The one thing I'll tell you too is even though we had almost 20% up years in a row for the S&P, this market is still only middle-aged. The average post-war bear or bull market lasts for about 6 years. We've been in this one for about 3. The average post-war bull market goes up about 152%. We're up about 100%, a little bit more than that, off those October 22nd lows. So we feel like this market's middle-aged and have a good feeling about where we are, especially with all the tailwinds being created by this dramatic technological revolution. So here's the bottom line. For 2026, we see equities going higher. No recession, good earnings, higher equities. In terms of size, we like the SMID caps. You pick up more of the industrials, financials, materials, and energy when you come down the cap spectrum because the large caps are really dominated by the Mag 7, so we think they'll outperform. In terms of style, I like dividend yields in here as people get more nervous about deficit financing and capital market activities. Google just floated a 100-year bond offering yesterday. It was subscribed, kind of a magic act. But nonetheless, I think the amount of debt that's going to be required, the circular financing, is going to force people to really appreciate dividends again, so I like value. In terms of domicile, I think the international trade has legs. Europe and Asia both have stimulus in the pipeline for their own economies, and we're going to cut rates by damn, and that could obviously lead to some weakness in the US dollar, as I show here, and that would also be a benefit for international holdings and stocks held abroad. In terms of US interest rates, I think they just stay higher for longer. If you're imagining a 4%, growth economy or anywhere close to that, then you can't really make a case for long-term interest rates to go down much from here, even if inflation remains contained, which I think it can. And then on bonds, guess what, bond investors, you're going to get your 5% plus. Congratulations. What is the primary threat that we see in 2026? If productivity doesn't end up saving us, then you could see all that stimulus create labor shortages. If we have labor shortages, you could see inflation reaccelerate. If inflation reaccelerates, Trump is going to be at odds with his own appointed Fed chairman. That's going to create a lot of friction. It also likely creates higher rates, which hurts valuations. And so we don't want to see a reinflation story in 2026. I don't think we're going to, but that is absolutely the primary risk. So, bottom line, robots, AI, friend or foe? Here's the thing. We have a scarcity of labor in the United States of America. If we can combine those two things, create virtual workers, then we have limitless labor supply, which means we have limitless GDP capabilities, which means we have limitless prosperity. So I think it's good news, not bad news, and it's also important to take away this thought. I don't believe all of this digital, all of this AI combination of virtual and physical ends up being our competitors as humans. I think we need to think about all of that as basically our mind children as humans, as Moravec taught us. And with that, I will open the floor for any questions.
Awesome presentation, David. Thank you. We did get a couple of questions. Obviously, going to be conscious of time, but you did land the plane. Great job. One question we got. So traditional software as a service companies, if you think ServiceNow, DocuSign, Salesforce, they're all down 20 to 30% or so just in the first 45 days of the trading year. Do you think this is transient? Potentially due to the AI hype, or is enterprise software kind of over as we kind of know it over the past decade?
Well, I mean, this is the reality of the marketplace today. Stories within the market in a time that's so uncertain and disruptive become very powerful. And the story of agentic AI thinking and doing things and coding and all that kind of stuff, are very powerful. And as entrepreneurs are raising money, they tell lots of tall tales, like you can replace entire skyscrapers full of people with, an Excel spreadsheet and a piece of AI. Whether that's true or not, I don't know. But I do know this, it's so hard to figure out who the winners and losers in all of this are going to be. So I think the general level of risk in a tech-heavy portfolio right now is that you've got so much disruption. Obviously, the productivity will touch them. I mean, if you look at the number of employees that Anthropic and people have relative to some of the others, it's much less. So huge productivity leads to price compression. Lots of competition leads to price compression. So I think you'll have some great software companies that will certainly live because they understand how to tailor things and it requires some strategic thinking. But you'll also have some that die. And since you don't have clarity on that, it provides a discount and a warranted discount probably overall. This happened within the financial services sector yesterday as well. Somebody came out and said, look, we've got a widget that'll do tax return strategy, et cetera. And suddenly all the brokerage firms sold off because people think, well, we'll never need a person again. I've lived through this before. It was called robo-advisors. You were going to take all your money and give it to Wealthfront, never talk to a human being, and prosper. The reality is that people like to talk to people. I think the truth of AI is we still are humans and we want human interactions, and there's still going to be a premium on companies that do human interaction very, very well. So those software companies are going to prosper. Those that are just technicians could be at risk of replacement. So hard to figure out the winners and the losers. That's why we've reduced our tech allocation.
And aside from a lot of the benefits you outlined on artificial intelligence, how do you view impact on employment opportunities for just the workforce at large? Something that you and I probably have written about in the weeklies is kind of the K-shaped economy, sort of architecture of where we sit. In that sort of broader workforce, where do you see that go in the near term or maybe the longer term? And should we have a debate on sort of what this AI build out looks like in the near future?
So I think the workforce dynamics are really interesting. I have two children. I have a son who's more probably in the physical sort of space, and then I have a daughter who's in the virtual space, right? For my son, the coaching has been go places that absolutely require humans, right? So if it's sign building or have a company that builds houses, maybe you can have robots do it, but if you own the company, you're fine. And so the physical labor space, if you're into physical therapy, you're safe, right? So I think the physical labor space actually needs to kind of be revisited. And there's going to be a whole lot of manufacturing, obviously, et cetera. So I think there are opportunities there because I think it'll take a while for the robots to really be able to do what we do. In the virtual space, I think if you're pursuing technical degrees that don't really have an element of human touch to them, that could be at risk. And so for my daughter, it's, how is the networking going? Who do you know? Who are you talking to? I also think it's incumbent on all of us that are thinking about how to help people in the workforce today. The human endorsement, the human recommendation is going to mean so much more. So we've got to be more active as proponents for our kids, for our friends, whatever, more willing to make references, more willing to make recommendations, because again, carving out what is essentially human, the AI may be trustworthy, it may not be trustworthy. We need to do what we can to promote those within our networks, those that we love, to each other, because we've got to tap into all that is human in the future. The stuff that's just technical, you're at risk. If you're a graphics artist, this wasn't something we painted, right? This on the screen was something that we requested from the AI. Could have required, 2 people at a desk for a month or something, I don't know, to make that happen. So I do think in thinking about the future labor force, it is so important to stress the human skill sets, trust, empathy, care, understanding. That's what's most important, and that's what we talk about and concentrate on most, really, at WNA.
And to piggyback on that, another question we got, it seems to me that the only way to fill the future AI-generated jobs will be with highly educated folks that typically come from U.S. educated workers or foreign workers. Where do you think these workers actually come from to fill those jobs?
Well, right, at some point, I'm not talking singularity, but at some point, the robots will be smarter. They'll think differently. But I do think that the ability to think strategically, the ability, so that brings the liberal arts education back into vogue, right? We were done with that. We wanted to do just STEM, and we were like, all you got to do is STEM. STEM's great, and I'm sure there are opportunities there. But in a world that becomes even more human because of all of the artificial intelligence, I think the liberal arts stuff becomes important too. So, maybe the philosophy majors have a role again, and maybe the art history majors have a role again. So I think that in the future, again, like I'm saying, the robots are going to be our children, not our competitors, but we'll assign them tasks that are largely technical. The tasks that require strategic thinking are largely going to be those that remain the domain of the human mind. And by the way, the robot, this is the problem with economics. Economics assumes that all individual actors within an economy are rational. Guess what? We're not necessarily rational, right? And so the robots are only going to do things that are rational, but we as humans do all sorts of crazy things that are irrational, and I don't exactly know how AI is going to calibrate for that. So again, liberal arts, I think, ends up being back in demand, and I think STEM education is awesome. As you say, probably you need to be overeducated in that field because the lower level tasks we're going to automate away.
Okay, and last question, you mentioned reigniting of inflation as greatest risk in the presentation. Outside of that, what other risk on the horizon would derail what we've talked about today?
Well, a lot of people talk about possibilities. I mean, it's possible that there's a nuclear war. It's possible that, there's a long list of horribles. We don't really invest on that. We really invest on what's probable. It is not probable that inflation reignites. The markets are calibrated to that, but it's possible. And if it does, then we'd probably reposition portfolios. So for the geopolitical events, China invades Taiwan, the US goes to war with Iran, things like that, you can't really position the portfolios for those in advance other than to go to cash And I think that would be a major mistake when we're in the midst of this massive productivity shock. So I do think inflation is the major worry. The other major worry is kind of an shit moment like happened in March of 2000 when suddenly, one of the tech companies could come out this year and say, let's take OpenAI. We couldn't raise all the money. By the way, we don't think we can really monetize all the spending. So we're basically the Enron of this generation. That is possible. I also think, people could come out and say, we're not going to spend at the rate we said we were going to spend, and that could create some tremors. We saw that a little bit with Oracle's debt, spread widening last year. Because we see that as a risk, we have dialed back our exposure to the space to see how all of that gets sorted out. So we've already adjusted, I think, for one of the risks, which is a foot fault from one of the major technology companies. From the inflation risk, we're calibrated to a low inflation environment, but we've rotated towards lower PE stuff that pays dividends. So we might insulate ourselves if there ends up being PE compression. Obviously, that's a live thought that happens all the time. But as far as the things like geopolitical worries and that kind of stuff, or the reversal of Trump's tariffs in the Supreme Court, people worry about that. I don't. Even if it happens, I think everybody gets a check back. That's probably just stimulus. Or they'll find another way around it. So I think the real big risk is inflation, maybe a footfall from AI, maybe a little political disturbance, but nothing I'm changing the portfolio view over right now.
Awesome. Thanks, David. That's all the time we've got today. We'll let y'all get back to your busy lives. Thanks, David, and thanks to everyone for joining us. If you have any additional questions, please reach out to your dedicated W&A wealth strategist. And if you don't have one and would like to have one, feel free to email us at request@wealthstrategists.com. We'd love to connect and have your family join ours. So with that, thanks again. Hope to see you again at our halftime report later this year.
Thanks, everyone. I know that was a lot of information. Obviously, we will send it out as a replay. We will have the slides available. The main takeaway is remember the robots are not your competitors, they're your children. Thanks, everyone.